What's up, guys? This is Wade with Trade ATS, and in today's lesson, I'm going to show you how to use information from your losses to immediately help you make more money. Let's get into it. Over the last decade, I've literally worked with hundreds of traders in person, trained them, I've seen what they do, and I've worked with thousands of traders through our online programs indirectly. Believe me when I say, a lot of traders face this problem I'm about to go over. The problem for most traders is they take too many losses when trying to find the perfect entry into a trading idea. Think about that. Is that something you can identify with, where you're trying to get into a trade setup that you see is happening, and you keep taking small losses over and over and over again trying to find the perfect entry? This situation can get so bad that you get to a point where you literally need the idea to work out just so you can break even on all the little losses you've been racking up trying to actually get into this move. So as you can tell, this problem can really kill your ability to be profitable. I know, I've seen it, I've dealt with it personally. So throughout the rest of this short presentation, I'm going to show you a way around this problem. I'm going to teach you a simple trick to limit all those unnecessary losses that you rack up trying to find those entries. And I'm going to teach you how to use the losses that you do end up taking, because losses are unavoidable. You will take some, but I'm going to show you how you can take those losses and use them to make even more money than you would have if the first trade originally worked out. Sound good? All right, so I want to introduce you to this idea of what I call defining dead zones. So we'll get into what that means in a second. Just to reiterate the problem, has this ever happened to you? Let's look at an example. As you can see in the green arrow, our HTF, or our higher time frame, is in an uptrend. So this could be whether you're trading a 5-minute into a 4-hour, it could be a 15 into a daily, it doesn't really matter. But the higher time frame is in an uptrend, and the candles we're looking at are your lower time frame. So as a trader, I'm sure you know the golden rule. You always want to trade in the direction of the prevailing trend. So that's what you do right here. You see that the momentum's starting to pick up on the lower time frame. So you jump in right here and you stick your stop loss right where that red line is. You're trying to be real conservative and just catch some of that momentum. But what happens? Well, market goes up, boom, comes right back down. You take that small loss. No problem. Shake it off. You'll wait for the next setup. Here it comes. Boom, momentum's picking up, you jump back in, you stick your loss right down below the low at that candle, but then what happens? Uh-oh, another loss. Okay, this is starting to get concerning. You got 2 back-to-back losses. I know we've all been here, right? Okay, here it goes. You jump right back in where that B in the green circle is, stick your stop loss down below the low at that candle. This one's got to work out. It comes back in and it gets you again. That's 3 losses in a row. And then finally, if you're brave enough, you jump back in and this one finally puts you in the money and you're thinking, finally, I hope this keeps going. I need to make back all these losses. It better work out. We've all been in this situation. Now I want to say something that I've said many times before in many different trainings. Every single trade you take should give you one of 2 things. If the trade is a win, it's going to give you profits. If the trade is a loss, it should give you information on how to profit in the future. If you're going to pay the money, you better be getting some information you could use. The key thing I want you to recognize here is how much money you spent in losses for the same information at the same price level. And the price level is key. Your first loss should have kept you from compounding further losses because you defined the dead zone or the no trade zone off of that first loss range. Now I'm going to show you the simple solution to this problem. In this example, we're going to be working inside of a downtrend on our higher time frame. We're also going to be working with established market value. If you don't know what that is, after this video, go look at our master pattern video series. It explains everything about the master pattern concept and establishing true market value. So with that value line, let's pretend that we're going to take a short trade right here, and we're looking to get right back to value. That's our minimum upside profit target, and there's a 20 pip distance there. We're going to keep this example real straightforward, so we're going to go with a simple 1-to-1 risk-to-reward ratio. We're going to stick our stop loss an equal distance of 20 pips away from our sell position. Now what happens? Unfortunately, this trade doesn't work out. Price drives right up through our stop loss, and we book a negative 20 pip loss. No problem though. What do we do now? Well, we're going to use this loss range from where we sold to where we got stopped out to define a 20 pip dead zone. This is going to be an area that we are not going to open up trades. I don't care if the market looks like the best setup on the current candle, you are not going to trade inside this dead zone. And the reason for that is because we can't get any new information. We already know this is a losing area for us. What happens next? Because we don't want to compound our losses at the exact same price level, we're going to look to trade above or below this dead zone that we've defined. In this case, the market is trading above the dead zone. So we're going to define that as our new trade zone. So we're looking for some sort of turn, some sort of setup that's going to be above the dead zone in this example. So the market trades sideways a little bit, and we end up selling the market again right here in our new trade zone. So now that we're in this new sell position, what's the first thing we need to think about? Well, we got to protect it. So we got to put in a stop loss. In this case, we're just going to pick above the recent highs, give it a little bit of room. Let's say it was probably a 20, 25 pip stop loss again. What you need to understand is that if you do get stopped out on this trade, that new stop loss level is going to extend the current dead zone. So it'll push it all the way up to there, and you're not going to want to trade anywhere in this range. And there's a reason for that, which we'll get to in a second. So now's the time where I unveil the whole purpose of this exercise I've been walking you through. This is the aha moment part, and it really comes down to simple math. From this new sell position, there's going to be an additional 12 pip gain because we're working back towards the same target. So we have an additional 12 pip gain we're going to make just to the top of the previous dead zone. Plus, we're going to recover the 20 pip loss that we originally had because we stayed out of the dead zone. We didn't compound losses in that same area. And we're going to get the original 20 pip gain we were hoping to get coming back to the same exact profit target. And what's key is having that established static level profit target that you're working towards. That's why understanding established market value is really the most important concept that you can understand as a trader. That's what everything we pretty much teaches hinges on understanding that concept. So just to drive my point home, by staying out of the dead zone that you've previously defined, you can not only recover losses, but you can also potentially increase your opportunity. And I didn't even talk about raising your lot size potentially to compound your wins because you're not losing money in that same price range. So there's a lot of different ways you can work around this concept and make it really work for you. So let's briefly go over the key takeaways that I want you to get from this presentation. This technique works best in a strong established trend using the master pattern framework of established market value. Again, if you're not familiar with the master pattern, go to our YouTube channel. You'll see that we have videos called the master pattern. They explain everything about that particular methodology. It's really important that when using this method that you're working towards a static price level that you expect market to gravitate towards. And using that true market value, that established value, is perfect for that. As price deviates away, you can measure the exact pip amount that you expect to get as it comes back. The second point I want you to take away is that you really only need to lose once using a relatively moderate stop loss to begin to define a dead zone. You don't need to lose 1, 2, 3, 4 times before you finally say, okay, I shouldn't trade in this area before. Use that first loss as a clue, block out that range, and trade either above or below it. And finally, by defining a dead zone and placing future trades above or below, you either get better confirmation if you trade the breakout back into trend above or below your defined dead zone, or you get better entry to make back those initial losses plus new profits if the market continues to pull back further above or below your defined dead zone. And this is providing that the overall trend stays intact. And that about does it. So thank you so much for taking the time to watch this video. Remember to like and subscribe to our channel if you want to get notified when we make future lessons just like this one. And if you're interested in learning more about what we do, go check out our website at tradeats.com and also our new prop firm at atscapitalpartners.io. We'll see you on the next video.